Good afternoon, everybody. We're going to get started with our 2 o'clock panel. We're going to switch gears a little bit. We're going to talk about property insurance, and we're going to talk about property catastrophe modeling. So we talk about cat modeling. That has nothing to do with the animal. We're talking about catastrophes. My name is Matt Young. I lead U.S. property treaty underwriting for Swiss Re, a global reinsurer. And the general premise here is property losses continue to rise. 8 of the last 10 years, we've seen 100 billion plus in losses, mostly driven by what we call secondary perils. So we'll get into what that is in a moment. If you look at the prior 10 years, that happened just one time, inflation adjusted. So clearly we see a trend of rising property losses. And what we want to do in this panel is talk not only about what's driving that trend, but we want to talk about how we model it, how we try to get our arms around what an average loss is in any given year, and then what do we do to mitigate it. So we'll turn the corner and move from talking about quantifying it to actually how do we lower it or mitigate it to make some progress in having more resilient communities and lowering losses. With that, I should also add, I said who I was. I'm a proud Drake alum as well, which we haven't heard a lot of yet. So anyway, happy to be here. Why don't we walk through, we'll do some introductions and then we'll get started.
Hey everybody, my name is Nick Antoniou. I'm a senior treaty underwriter for MS Reinsurance in the regional and mutual segment. I started my career going down the actuarial path. I'm a proud University of Illinois alumni, so ILL. I started off my career in straight into reinsurance, but I quickly transitioned from the actuarial side to treaty underwriting. It fit my personality a little bit better. I wanted to be a little more client-facing, but it still scratched the itch with the technical aspects of underwriting. You want to talk about most interesting spots?
Yeah, tell me the most interesting
there
place.
was a question early on about talking about our most interesting locations that our careers have taken us, and I struggled a little bit to come up with something, but then I thought about it a little bit more, and it comes down to not so much a single location, but more of a culmination of places I've gone in my career, because in the regional mutual segment, I touch on clients that range from single state $10 million riders to nationwide billion-dollar carriers, but they all have a very clear pride in their local communities, and they have their home offices in a lot of these local communities. And when I go and visit their home offices, I get to see all the little nooks and crannies of this country that I don't think I would have been able to in any other career. It also comes with some golf every once in a while, so I can't complain too much.
Excellent. And I put that question in there as far as what's the most interesting place we've been in our careers for the students in the room who, when I was here at Drake, I never could have imagined the places that I would get to go and the things I got to do. So as we continue on, they'll answer that question. Matt?
Yeah, so I'm Matt Trost. I'm currently the VP of Ceded Reinsurance and Capital Modeling at EMC Insurance. This is a local employer here. I have been in our actuary department for over 25 years. The first half of my career was the traditional actuarial work and pricing and reserving of insurance. And the last half of my career has been more on the predictive modeling side. I've been overseeing our capital model for the last 12 years. And then the last 5 years, I've been managing our ceded reinsurance portfolio. I also support our cat modeling team. And those have all kind of merged together over time, but I definitely think it makes sense kind of that I have kind of support all those areas, as they do kind of intermix pretty well. As far as the most interesting place I've been in my career, before the ceded reinsurance stuff came out, I probably didn't have a really good answer to that. But now being part of ceded reinsurance, I do get to travel to see reinsurers. In the last couple of years, been able to fortunately go overseas to the London markets and see Lloyd's of London, and also to go to Bermuda. Thankfully not during hurricane season, but yeah, it's been a great experience.
Good afternoon, everyone. Erdem Karaca. I'm heading the cat perils team for the Americas region at Swiss Re, working with Matt. Happy to be here today. I am an engineer by training, civil engineer. I have a PhD in civil engineering. I've been with Swiss Re for 13 years in total, but I went to a primary insurer in between. So I went for 5 years to risk management and came back I have a team of scientists, engineers working on CAT models, their development, validation, and use with underwriting. And again, being part of a reinsurer, I think I've been to Swiss mountains multiple times, so I try to keep it short, so it's less interesting, but I've also been to like Japan, Mexico City, a couple of other places, so you get that global exposure to different cultures and businesses.
Okay.
Good afternoon. My name is AJ Mumm. I'm the Emergency Management Director here in Polk County. And about the only thing I know about insurance is maybe to pay the premium and where to send it. And my wife helps me with that. So you might think, well, what in the heck am I doing up here? Hopefully we can connect a little bit about why emergency management might have a spot on the stage here. My background, I'm also a Drake grad and also went to Iowa State University for my graduate work in community and regional planning. My undergraduate work is in biology and geography, and again, you're like, I don't see the connection, but I guess it's a journey that takes you in different places. In terms of the most interesting places I've been in some pretty crummy places, honestly, with this type of work. You see people on their worst day, you see communities that have been really devastated. So that's definitely not fun, but it is an opportunity to learn why you do the work you do. So yeah, I've been in communities that have been devastated by tornadoes and in muddy, mucky basements of people that have suffered a flash flood event, but also been in 48 of the 50 states doing a lot of teaching. Been in most of those states emergency operations centers. And over the course of the last 5 or 6 years, been to the Republic of Kosovo 8 times with the Iowa National Guard and the U.S. Army. I have not served, but as a civilian advisor on, if you know anything about Kosovo, a pretty rough history over the last 1,000 years, honestly. But here in the last 20 or so years, a republic that's getting their feet back underneath of them, and with that comes a look at risk and emergency management, training, planning, exercising, one of the world's newest countries. So that's why I would put as most interesting.
Excellent, that's great. Well, let's start with you, AJ. Before we let these guys talk about the insurance piece, I won't have you talk about that. But we're sitting in Polk County. Tell us how you evaluate the risk for Polk County.
So it really starts, we heard the previous panel talk a lot about why, and massively important. The purpose of our hazard analysis and risk assessment is really to do a lot of learning about what the community's threats and hazards are, and then apply those as a prioritization tool. Really not getting into the actuarial and statistical analysis. There is a small part of that, but we look to experts that are sitting up here to help us interpret that. But our purpose is really to know where our future investments are going to be in terms of hazard mitigation, planning, training, equipment, supplies, a lot of what the community needs to have before that next disaster occurs. And so the hazard analysis and risk assessment allows us to cut through some of the perceived risk and get right down to some more, an analysis that has some substance behind it. And a lot of times people's recency bias is pretty strong, is that we should prepare for whatever the last thing that struck the community. And that may be a one-off, or it may actually be, a point that adds to that trend. But regardless, it's more of a larger scale. And you see the slide up here, kind of how we do that. Start with really loading about 30 or 40 different hazard types. And each of those types has probably subtypes and so on and so forth. So you have to kind of make a determination of how much detail you want. But in terms of, there's going to be natural hazards, there's going to be man-made, there's also going to be technical hazards in that mix. And then you start looking at their historical occurrence, probability, vulnerabilities, and severity of impact. With with the severity of impact and the vulnerabilities, we're really looking also at our, what we call community lifelines. These are significant systems, whether they be electrical, power, transportation, communication, water systems. Those are all looked at and viewed through the eye of what vulnerabilities they have and what severity it would take to, maybe it's just to disrupt them temporarily, or maybe it's a complete destruction and everywhere in between, so we can add some scale to that. And then also looking at speed of onset and geographic impact. And so with our geographic impact, it does not make sense for every community, especially our smaller communities, to have every exhaustive piece of equipment and endless supplies sitting in a warehouse. So there's a lot of mutual aid or assistance that takes place between our communities, not here just in Polk County, but generally across the country. And so when we talk about geographic impact, if you have a regional hazard like a winter snowstorm or a blizzard, usually that doesn't stop at that line between Windsor Heights and Des Moines. And so there's a great deal of impact that the geographic analysis has on that as well. Then lastly, we look at cascading impacts, because this is what can really turn an emergency into a disaster. And I know it's easy to kind of use those terms interchangeably, but in our world, an emergency is something it might be sudden, it might be even unexpected, but you generally have the resources to address it. So consider, somebody has a medical emergency, the community has adequate ambulances, proper health systems, and we can deal with that. It's still an emergency, but we have the resources to handle it. On a disaster, as we start exhausting some of those resources, or they're not available in the quantities or in the speed that we need to acquire them. So all that gets factored in, and on the upper right-hand side, you can see what it's a very rough representation, but we're just trying to prioritize what are the most frequent and impactful disasters, and separate those from those that might be in the news a lot, but more of an inconvenience, or not necessarily have a long-term impact, and then be able to invest in mitigating those.
Thank you. I think how you approach disaster preparedness and just identifying what those disasters are, I think has a lot of correlation with what the insurance industry does. Sticking with the Polk County theme, Matt, EMC calls Polk County home, and AJ just described how they go through and identify a lot of hazards. Insurance companies do the same. How would you explain how the insurance industry takes those risks, which can be seemingly scary, and turns it into something that we can understand, provide insurance for, and ultimately help our communities be more resilient?
Yeah, I mean, it definitely kind of piggybacks on what AJ was saying, but from an insurance company perspective, we have, I can think of maybe 2 or 3 different functions within the company that really evaluate the risk of a property or an insured, and that would be, underwriting, who kind of seeing that before we put it on the business, put it on the books. There's actuarial, they're trying to price, what should we charge that based on what we think the risk is. And then we also have a risk control function, which is really, can go out there before we even buy in the business, that goes out and actually looks at the physical premises to evaluate the risk of it from a geographic or risk control, risk mitigation strategy perspective as well. I'll speak maybe more to the actuarial side, where, actuaries, we love data. We love lots of data. So the more data we can get, the more credible it is to us, the more predictive it can be. But we're really looking at an individual risk or types of risks. We can look at their historical experience, right? That talks about loss frequency, but also then loss severity. And we can use those things to try to price it correctly. But all that is really based on historical experience, and that can be to some degree a little bit random, right? Especially when you're talking about individual risks. Obviously, the bigger the portfolio, the more predictive it is. So yeah, the more that we can either use industry data or company-specific data, the more that we can rely on that. But again, that's historical information. And kind of where this discussion is kind of going is talking about predictive modeling, right? And so, predictive models, they're trained on historical data, calibrated to historical data, but then provide a larger range of potential outcomes. And that's really where that next level of understanding the potential risk that's out there in terms of the likelihood of an event, but also what's the range of severity of that event can be very informational in terms of evaluating that risk profile.
Great, thank you. So we mentioned CAT models. Maybe before we go further, it's one of the most fascinating things about property insurance, in my view. Others might not be so fascinated by it, but Erdem, why don't you just walk us through what is a CAT model, how do they work, before we get into more questions about predictive analytics?
Happy to do so. So they've been around more than 30 years, so they're not new, but they're changing, evolving, like similar to other models. So sometimes we refer to like Hurricane Andrew from 92 or Northridge from 94 as events that kind of accelerated their development and adoption by our industry in general. At the core, they are probabilistic or stochastic models that help you quantify risk associated with natural catastrophes, earthquakes, hurricanes, severe convective storms. They're typically they're informed by history, but they're forward-looking. So in the end, we're trying to look at the next couple of years, next year, 5 years or so, to assess that profile. There are companies who develop these models and license to insurance and reinsurance companies. We also, as insurers or reinsurers, make them our own. Either we license them, build them our own, make them our own, fit into our organization and risk metrics. The framework of the models, it might vary, but I call it here, I have a slide. Maybe we can click through a couple of others so that we see all of those. Typically it's called a 4-box model. Whether it's 3 or 5 concepts are the same. So you have a module to assess the hazard. So whether it's severe convective storms, you need to estimate where the hail is going to be, tornadoes, their severity. So there's, again, a stochastic module which creates potential realistic events just to enrich maybe the history, but also to come up with totally plausible new events. So we take, that's one basic component of the models, and there are different approaches. The second one is a bit vulnerability. So this box is a bit looking, if this college campus is exposed to a certain wind speed, what would be the damage or loss given that intensity metric? So you try to come up with these more in a always probabilistic sense. There is always variability and uncertainty so that you can convolve with the hazard piece and come up with risk metrics. The third box is what we call exposure. So this is defining the characteristics of your properties. If it's a single family home, when was it built, what's the roof type? For a commercial industrial facility, it might be different things. And a bit tying to the insurance domain. If there's coverage, what's the deductible limits? It can get as complex as the insurance policies or reinsurance policies, but it's really trying to capture all these pieces, put them together, and then try to come up with answer questions like what is the chance of this campus being exposed to 100 million loss, or an insurance portfolio being exposed to 1 billion events from hurricanes, or 1 billion loss within a given year from all potential nat cat risk, and those are the type of questions that we are trying to answer. So there are a couple of examples on individual pieces. Maybe I hate using this cliche, but a bit like garbage in, garbage out. I will use it at the end, but I will highlight a couple of things. Again, the framework is fairly stable, it's established, but how we do things now is very different than 10, 20 years ago. With increases in computational power, the science, the new knowledge, you try to bring them in more, increase the resolution of the models, increase samples and everything. So there's a lot of enriching, and how we approach, again, is tied to history, but evolving over time. Next one, maybe Matt. Couple of things. We always have a debate, where is there more uncertainty? Is it the hazard part of things or vulnerability part of things? If you're a modeler, that's one of the common questions. In the end, it doesn't matter, but just be aware there is engineering in it, there is data in it, but think about earthquake. The last major earthquake that we had in the US was 94 Northridge. Since then, we don't have any claims data. So there is a lot of science, engineering, expert opinion that goes into these models too. So where there is data, there is a lot of statistics, there is a lot of physical modeling, but there are cases where you have to rely on certain pieces much more. So you need to appreciate all that comes with it, uncertainty, and you need to be aware of the dependencies. Exposure, Matt also mentioned, like every insurance company, they put their portfolios together. This could be a small insurer with, I don't know, I'm going to make it up, thousands of policies in a municipality versus a national insurer with millions of policies spread out throughout the US, and CAT models sort of have to serve all these different sizes of portfolios and different type of risk. So computational speed, risk metrics, and the software has to work all together. This is the last slide a bit. I think I'll tie it to the next panelist a bit too, but again, I mentioned that it's in the end, we are trying to come up with risk metrics relevant for underwriters, risk managers, portfolio owners to make more informed decisions. It doesn't give you all the answers, right? It spits out all the metrics and numbers. But again, I mentioned uncertainty. You could see very, very different answers depending on which model you look at, and these evolve over time too. So it gives you confidence, it gives you numbers, but you need to understand end-to-end process to be able to make really well-informed decisions.
Thanks, Erdem. That was great. Now, Erdem explained what CAT models are, but I think they're used for far more than most people would ever realize. So if you're a customer service rep or an agent or somebody who's entering information on a home or a business, to enter that information, or it gets pre-populated, and that's great because that's what you need to get a price for your insurance. But once it enters that system, it's then used by many, many other stakeholders for many different purposes. So Matt and Nick are going to walk us through everything that these CAT models are actually used for, beyond just coming up with a number for what could a loss be. Matt, maybe should we start with you, and then we'll come to Nick?
Yeah, we'll start on the primary direct side and then kind of migrates up to the reinsurance applications. But so yeah, again, I support the CAT modeling team within the actuary department at the company, and it's a good fit in that it does touch a lot of things and goes a lot of places. As Matt was alluding to, once that policy gets thrown into the system, right, with that location of where it's at, and location's a big key, it goes a lot of places. And so it's not only in the pricing of that insurance policy, but then, it goes into risk management. We have a top enterprise risk at EMC that's basically our property CAT exposures. And we use the CAT model to evaluate that and measure our risk on both, what's a large single event look like, but also what's, our annual aggregate losses. What are our expectations for that? What's the range of that information, or range of those results going to be? And we can use that information to help monitor and again, keep our CAT risk within our tolerance, which then obviously rolls up to our enterprise risk that we've talked about earlier today. So, that's one key piece, and then we can also utilize that and manage that at a desk underwriter level, where we can talk about exposure concentrations. When we put that pin on the map of, we've got a policy here, that adds exposure to a certain area. And so can we leverage the CAT model mapping or geocoding capabilities to say, okay, how much do we have in a 2-mile area around this? And is that manageable? And that informs underwriting too, of, let's be conscious of where we're adding risk and making sure we're doing it appropriately. So the risk management's a big part of it. The CAT model results, they flow into our economic capital model at the company. And that's, the capital model is there to kind of measure our overall enterprise risk. And so it's a key portion of that input there. So again, just kind of continue with corporate risk management and the applications for it. But even outside of just EMC, let's say the company perspective, there's the insurance and rating agencies that like to look at what's your 1 in 100 event and how well are you capitalized to support that. And so that CAT model information can be very influential in trying to understand surplus adequacy that you might have as an insurance company. Maybe I'll stop there and let Nick add a few.
Absolutely. So I'll talk a little bit about things that are more near and dear to my heart. I'm on the reinsurance side. So I wanted to talk about the reinsurance application, especially in the pricing side of what we do. So for those that aren't familiar with what reinsurance is, the quick primer is we are insurance for insurance companies. So we cover companies like EMC for things like large catastrophe risks. And the product that is used for something like that is a catastrophe excess of loss treaty. And the easiest way to think about that is if EMC, for instance, has a portfolio of homeowners in Des Moines, and a severe convective storm comes through, EMC will retain a certain portion of the losses. We call that a retention, similar to a deductible. And then reinsurers will pick up the losses in excess of that retention. Now, in order to provide coverage like that, reinsurers need to be able to come up with an expectation of loss for this portfolio, right? And there are a number of ways we could kind of come up with that. One is just using historical experience. You miss out on a lot of nuance with that. You could just put your thumb up in the air and come up with a number. Also ill-advised. But the primary approach is using catastrophe modeling. And the nice thing about catastrophe modeling, right, is it's essentially a small laboratory, right? You're running tens of thousands of years worth of simulated events through a given portfolio and coming up with a nice distribution on potential outcomes to that portfolio from all kinds of different perils. And that gives reinsurers a way to come up with what they think the expected loss should be in any given treaty period and then charge appropriately for it. One of the other components that kind of goes into reinsurance pricing, though, is the cost of capital. And when I say the cost of capital, that means, in a similar way for the rating and regulatory agencies, how much capital a reinsurer needs to keep on hand to be viewed as solvent or be able to fulfill its obligations in a scenario that is extreme, right? So reinsurers will take their own portfolios and model them and come up with the same simulations to come up with 1 in 100-year events, 1 in 250-year events to see what the worst case kind of scenarios are and hold on to enough capital that is liquid enough to be able to pay out in scenarios where a big claim hits our portfolio. Now that all gets kind of pushed down through the reinsurance pricing and that gets loaded into the premium and that gets passed on to the primary carrier that we're insuring. The one other sort of similar concept is the ILS, which is insurance-linked securities. That's essentially a method for the capital markets to participate in risk transfer in an insurance context. Their most well-known product is probably a catastrophe bond, which actually operates very similarly to a catastrophe excess of loss treaty. It's just bundled in the form of a bond. The capital market providers think pension fund, think Wall Street Bank, think large family office. They collateralize a vehicle with capital. That capital is sitting there and has triggers associated with it to pay out in the event of a catastrophe on a company like EMC, let's say. In return, EMC will pay the capital provider an interest rate on the capital that's sitting there in the form of coupons, so very similar to a bond. If the capital is not required, there's no loss that happens in the year, it just gets given back to the capital provider and we move on. But in the same way that catastrophe excess of loss treaties need to be priced using catastrophe models, catastrophe bonds get priced in a very similar method, right? And the capital providers in these scenarios are generally a little less sophisticated as far as true insurance underwriting expertise goes. So they truly rely on the outputs that come out of these catastrophe models, and they're playing generally a little higher up in the risk spectrum. So the numbers that come out of these cat models are very important to them to be able to contextualize what's happening in an insurance context.
Perfect. Nick, we're going to stick with you. So now we've convinced them that cat models are great and that they're really good tools and that they're always perfect. I think.
Absolutely, yes.
Maybe not. So talk to us about primary perils. I mentioned secondary perils. I heard winter storm. I heard severe convective storm. We've got wildfires. We've got flooding. What's a primary peril? What's a secondary peril? And maybe tell us about the evolution of secondary peril modeling or why that's so hard.
Yeah, so it's a funny concept, right? Because we all use the terms primary and secondary perils quite ubiquitously in the insurance industry, but there is no real formal definition, but we've all kind of come to an understanding of what it means. A primary peril is, generally speaking, something that that can produce very severe events with lower frequency, right? So you're thinking about hurricanes, you're thinking about earthquakes in Europe, you might be thinking about like winter storm type scenarios. These events can cause capital erosion to the risk-bearing entities from a single event, right? These are multi-billion-dollar events that could happen. Because of that, they've always been at the forefront of concerns for the risk-bearing entities, so they were the primary, no pun intended, focus for vendor models and catastrophe modeling companies to focus on. So there's been decades of research and evolutions and iterations behind these models, and they've come to a stage where they're relatively more mature. Each individual iteration is not as dramatically different than the last, and the science is relatively well understood and known throughout the industry. Secondary perils are an entirely opposite beast. Essentially, the severity spectrum normally ranges low to medium, although we've seen some very large secondary type events, especially through the Midwest. But they also have a preponderance to be very frequent occurrences, right? And so we're talking about perils like SCS, which is severe convective storm. Think straight line wind, think tornadoes, think hailstorms. But it's also flooding, it's also wildfires. These events, while not hugely severe in and of themselves in most situations, the fact that they happen so often causes massive aggregation issues for risk-bearing entities, right? So when Matt talked about 8 of the last years being north of $100 billion of insured loss, the vast majority of that loss comes from secondary perils. SCS being one of the big ones, wildfires, as you can imagine, the wildfire in Los Angeles this year was quite dramatic. The issues around secondary peril modeling is kind of twofold. One being all the focus was on primary perils for so long that the maturity of secondary modeling is just not quite at the same level as primary perils just yet, although it's come quite a ways in the last 10 years. On the other side of it, secondary perils tend to be significantly more sensitive to changes in the risk environment. And a couple of these things can be, population drift. As people move off the coast, move inland, you don't have as much data for where these new population centers become. It's hard to back test your models on things like that. Climate change is another very sensitive assumption that's used in the models, and you can debate it with anybody and you'll come up with different assumptions and have very different outcomes on the modeling side. Another issue is the detailed risk characteristics that might flow into some of the secondary peril modeling. Think flood modeling, for instance. It's very important to understand base flood elevation. It's very important to understand where the forced floor is. It's very important to know if there's content in the basement, if it's finished. It's very important to know the topography around any individual risk, right? When you're very active about it, you can get that kind of information from your insured, but universally speaking, we are not at a point in this industry to be able to accumulate detailed information that way and use it credibly. So there are a few issues there. I think the industry is moving definitely in the right direction. We're getting better at modeling, and it's just a matter of time for these models to really start maturing with us and us being able to gather more detailed information to be able to model appropriately.
Matt, can I add something? So
Please.
Maybe another difference also is, so we talk about earthquake or hurricanes, they tend to affect the large area, right? So the thing about hurricanes, it affects the metropolitan area. The wind speeds, all of a sudden, block to block doesn't change from 100 miles to 0 and then 100. But if you think about some of the secondary perils, wildfires, you have a block burning, next block nothing happens. Flooding, same thing. Over a short distance, what you experience could be very different, and that's extremely challenging to model.
Yep.
As well. It requires higher resolution, more events, but also a lot of dependencies, like wildfire too. It's not your facility, your site, but what the community does affects the outcome of an event. You can fight it, right? It's very different than, let's say, an earthquake, where it happens, there's nothing you can do, for example, maybe other than shutting off your gas valves. There's not much action you can take. But as you go to more complex ones, it gets more challenging to model. But again, second generation, third generation models are coming up, and it's going to improve over time.
Great, thank you. All right, AJ, did they cover the insurance piece okay?
As far as I'm concerned, no.
Okay, good.
Good stuff. I'm learning a lot.
We focused the conversation so far on insurance for catastrophe, or the catastrophe models used for insurance. But you do risk assessment. Just walk us through how you would compare the sophistication of the tools at your disposal today for risk assessment compared to a decade or so ago.
I appreciate only using a decade because it probably go back a couple. But it starts with some very siloed, difficult sources to extract relevant data or information from. And so, I can think back to going to this building, to do the research, to have to look at microfilm and to go to the card catalog and find the old school stuff, right? And obviously that has changed a great deal with accessing databases. I think we still have a ways to go in terms of knocking down some of the silos and having that data be more available and integrated. But I think, I don't know if we've used the term AI or artificial intelligence yet for this panel, but if you were keeping track out there, I think there was probably AI was used, we're probably approaching 60 or 80 times so far today, and I think for good purposes. And I think that as we evolve, some of the photos, it gets kind of cluttered up there, but the old, flood insurance rate maps that were some form of black and white or purplish color, and you could not see block by block. It was tough to say, well, is that where I'm at? I don't know as a property owner or investing in property is hard to tell. And now we're getting into the area where that geographic information system, Google Earth, and all of the GIS and internet-based mapping is readily available. And then you start laying over top of that with a lot of engineering work, again, stuff that I appreciate but don't understand the ins and outs of. But people like at the Iowa Flood Information Center over at the University of Iowa, are doing some great things of putting, you can see there that the middle photos of starting to overlay not only the geographic spatial location of flooding, but also then to look at depths. And putting this information in the hands of the property owner, the insured, I think is probably the right term to use, gives them the power to evaluate their own risk. So they can use simple slide bars by saying, if I experience a 3-inch rain over 12 hours, what can I expect my local stream to do? And if that now shows up both horizontally, but also they can tell depth of floodwater. It's examples like that that are appealing to as a human being, to humanize it, right? Is not to see a black and white map that has cross sections on it, but to really look at my own home, my own property with these scenarios that I control, and to be able to look 360 degrees around that at the same time just brings a human level to it. And I think that's what motivates people to manage their own risk. So other things like drone technology and being able to put up a drone within minutes after a tornado, Greenfield tornado last year, there were drones up minutes after that. And so to take that video overlay, damage assessment information on top of that and have that available within almost minutes, but certainly within hours, is just remarkably it's a game changer for emergency management that we didn't have even 10 years ago.
Sure. I think even the visualization example is a good one, because if I do a lot of work in flood insurance, and if I say you're in a 1 in 100 year flood zone, you think that's not that big of a risk. Well, that's actually how we define high risk for flood. So, but if I can show you that if it rains an inch, your house is going to be underwater, that's much more powerful.
Yeah, and if I can just add one more thing, Matt, is simply the old way of saying, well, and you still hear a lot of people talk about that this is the 1 in the 100 year, this is a 1 in 500 year. And they've become kind of accustomed to that. But when you talk about, if the average person has a 30-year mortgage and you have a 1% chance every year rather than the 1 in the 100, translating that same risk, but translating it into a way that says you have a 30% chance over the life of your mortgage is a much different thing than understanding that it's the 1 in the 100 year.
And now it only took 40 minutes, but AJ's talking insurance speak now. So this is how it all ties together. The point really is that this is a multi-stakeholder challenge. So the insurance industry has to address these rising losses, which is where we're going to turn next in the last 10 minutes. But it involves far more than just the insurance industry. It involves homeowners themselves taking responsibility, or business owners. It involves builders, realtors, emergency managers, city planners, all of the to really have an impact. Because if we don't have some sort of mitigation, we're just going to continue to see rising losses that kind of all of us have to bear the cost for. Either, hopefully we can mitigate it before the loss happens. With that, Erdem, you've done some interesting research using CAT models on effects of mitigation. Can you just walk us through kind of the research that you've done where we're able to use these CAT models, not just to kind of put a financial number to a loss, but also say, how can we reduce that loss?
A couple of examples maybe. I mean, CAT models are great for as-if modeling, so it could be, let's say, for an emergency planner or manager, right? You can look at historical events, what's the repeat of an event, like with my current city, with my planning or so. If you extend it to, let's say, mitigation piece, right? There are many organizations who looks into building codes, effect of building differently better, like IBHS, Insurance Institute for Business and Home Safety. They look at roofs, performance of them over different conditions, different types. So they come up with these studies which kind of give you a relative performance indicator between different options, but there's typically a cost associated with building better. So CAT models are tools where you can combine, let's say, this relativities or vulnerability with the underlying hazard piece, and you can do quite a bit of cost-benefit analysis, and you can use it for quantifying and assessing incentivization programs. If you're a state agency, providing funding, you can use these tools where and how much you can do it. Also, as a policyholder, you're curious also, like if I'm putting my own money, $5,000, $10,000 for a better roof or different structure, kind of everyone does the math in their head, like what's the return on my investments? So you can do all the studies with that. What we have done is, we use CAT models a bit to look into future, right? So we get asked questions on climate change impacts. You can run a lot of scenario analysis with a lot of assumptions based on science or so, but you can look at current portfolio, market portfolios, how the risk can evolve. You can use it for strategic decision making. After Hurricane Ian, actually, we also looked at just at the market level, like how losses could have evolved if we didn't have different building codes. So we compared 1970s Florida with, the Florida of now, essentially, and excluding, let's say, things like inflation effects or additional cost of building. But just because where we live now, where we built, is tremendously different than 30, 40 years ago. So just the growth in Florida, in a relative sense, tripled loss potential in Florida over that period. But just because we're building much better, they haven't tripled, but kind of doubled. I'm rounding the numbers, but just it allows you really to look at all these mitigation impacts from better building codes, but also as an event happens when you're building better. So useful tools in that sense.
Great, excellent. AJ, back to you. You're on the front lines of mitigating risk and increasing community resiliency. What have you seen be particularly effective in that regard, and what's needed to move stakeholders to action when you've identified an opportunity?
I think we kind of touched on it in the last one, and it's really just that humanization and personalization of risk, overcoming. I mentioned recency bias, but there's also this optimism bias that I think as risk managers, I'm putting a pretty broad umbrella over all of us, that have to overcome a lot of self-rationalization of either not doing something, and Erdem just referred to some of those. So when we talk to a lot of folks about just taking maybe the 10 or 15 minutes a week to put together their own preparedness kit, you get a lot of the excuses, I'll say just bluntly, of why they can't. And some of those are up here, right? It's like, well, somebody will help me, or if it does happen, it's not going to be that bad, or I went through one of those 25 years ago and I didn't have any negative impacts. So there's a lot of those that we have to overcome. And I think some of the tools that we now have available to us fill in some of the missing pieces that were hard for people to personalize or to humanize and understand what impacts that has. We have to also carefully use bad things that happen in other places, not to scare, but to prepare. And you mentioned a lot of hurricanes and earthquakes and wildfires, and so to get back to like how we overcome this is to be more of our mitigation is more of a Swiss Army knife now than it was 20 years ago. Whereas 20 years ago, the emergency management world had like a plan for a tornado and another plan for a flood and another plan for hazardous materials. And now we're going more towards it's capability-based planning. And so it's another metaphor that I'll try to describe quickly is, you can have a recipe for something, but for a recipe to work, you have to have all the ingredients. Our approach now is to have a well-stocked pantry, and that whatever our tastes are, that our appetite is for that day or that evening, we can go to that well-stocked pantry and pull those resources out and apply them in many different ways. And so it provides a lot more flexibility. And you would think, well, that costs a lot more. And it actually was shown to reduce the overall cost because of the applicability of being well prepared. So that starts at the individual and family level, but then also escalates up to emergency response entities, the traditional law enforcement, fire, EMS, public works, that we can apply those in so many different ways. And our planning and training and exercising also has to evolve, and it is evolving to be able to utilize those in a more flexible way rather than a prescriptive way that might have been done 25 years ago.
Excellent. All right, we've got 3 minutes left, so this will have to be rapid fire. When you think about making real progress in loss mitigation, what do you see as the important next step? Nick, we'll start with you and we'll just work our way down.
I think this is what AJ was waiting for, AI. Will solve the world's problems. No, in my mind, it's better data quality that's coming through, higher resolution modeling, and the whole value chain being involved in trying to mitigate risk, right? If a reinsurer is modeling a portfolio, if they see something that's a policy that can be mitigated against, let's pass that along to the primary insurer to reach out to the insurer, and same thing with the primary insurer reaching down to the insured when they model their own portfolio. But even with that, right, we're looking at tens of thousands of policies in any given portfolio. You can't do that as an individual underwriter. That's where I do think AI might actually have some help in parsing through more information more quickly and being able to give out recommendations that way.
Yeah, I think I would echo a lot of the comments that we've had up here about just communicating to our insureds and the individual policyholders about what are the benefits of these risk mitigations strategies that they might have, whether it's putting a new roof on their house to prevent a less severe claim going forward. I think it's more about the kind of the predict and prevent, or even just mitigate loss, rather than just coming in after the fact and just restoring people to where they were. That's the nature of insurance, right? It's to try to restore people to their state before the loss. We want to try to help them, kind of evade that loss to begin with, or at least minimize it. So continuing to emphasize the communicate the value of these updated building standards or things like this that can be improved. Obviously, insurance, we can incentivize that to some degree, but you kind of go to that kind of cost-benefit analysis, making sure it makes sense to kind of follow through on some of those.
Erdem?
I'll continue maybe. You mentioned we don't want to treat all of these perils the same. We mentioned new roofs, it has a huge impact on hail, for example. You're susceptible to hail loss and damage. And as homeowners, you can get a better roof, metal roof, for example, rather than asphalt shingle one, and your vulnerability might be much less. That's something that you can control by yourself, but there are other perils like flood and wildfire. It's not just about your home, it's what your neighbors do, right? If you're taking care of your yard and everything, it's one thing, you reduce your risk, but if your neighbors are not doing it, you're affected. So it's, again, how do you bring these also neighborhood, community level impacts to CAT modeling and risk assessment? So that will be another frontier. Maybe AI will help with that.
AJ?
These guys took all the good answers. I agree. So And we're at
All
time,
right.
I don't know if there's time for questions, but.
So we've reached the end of our time. So I apologize for not leaving time for questions. We will be around if you'd like to ask us questions in the break, though. With that, thank you, gentlemen, for the great discussion on CAP modeling and mitigation, and ready to take it forward from here. Thank you.